Agile FX trading with purpose, growing in abundance. Hello, did you know Forex markets moves more money in a single day than stock market does in a whole month? Today I'm going to take you through a journey of how Forex trading started in centuries ago to how me and you can use can trade Forex market on our phones, on laptops, so long as you are having internet. Let's dive in. Upon finishing this lesson, you'll know the answers to the following questions. What is bartering system? Why was the bartering system so flawed? What was the commodity system? Why was the conversion to coins so significant? How did paper money come about? What was the gold standard? What was the Bretton Woods system? What is the floating exchange rate system? Bartering system involves exchange of goods and services. The items traded in the barter system were livestock, skills and talents. People sold. The issues that surrounded barter system. Having something that no one wanted. You could be having sorghum and someone want livestock. Limited self life. Fair exchange. There was no unit of exchange during the barter system. Transportation and storage of the goods and services was really difficult as you could move with all your livestock for exchange of mirrors, cow shells. It was really also hard to repay debt. In ancient China, Africa and India, cowrie shells were introduced. Trade in Japan was based on kuku, a unit rice. The shekel was specific weight of barley. The coins were also introduced. These coins were made from electrons. Reason why they were made and introduced, people could actually trade what they wanted for what they needed. These coins were also easy to transport. To make it more convenient, these coins were uniforms. As you can see, the issue surrounded these coins weight could change over time. As they dry, the weight could change. Coins could be counterfeited. Anyone could mold these coins so long as you get the source of the electron. Coins were also very heavy to carry. The Chinese invented paper money in the form of notes. Then private institutions started to store their gold and silver coins in exchange for the paper notes or certificates. The gold standard was introduced. All currency were to be backed by gold. The advantages of this gold standard, most people were familiar with it. It was also a natural occurring materials. The gold standard kept inflation in check. It was also a fixed exchange rate. The dilemma with this gold had to be free flowing. All countries needed to maintain money supply to fixed quantity of gold. If there was a need of transfer of currency from one country to another, gold will have to follow. International Monetary Fund was created before the end of World War II, July 1944. US dollar replacing the gold standard, becoming the world reserve currency. Meeting was held between the International Monetary Fund and the World Bank in August 1971, President Nixon closed gold's window and announced that US would no longer back gold. Floating exchange. A floating exchange rate refers to an exchange rate system where a country's currency price is determined by the relative supply and demand of other currencies. Currencies with floating exchange rates can be traded without any restriction, unlike currency with fixed exchange rates. By now, you should now understand the following questions. Write down the answer in separate journal. If you find this video helpful, please subscribe and share to someone who is curious who want to learn Forex from the ground up. Narrated by David Hero, trainer for Agile Effect. Sign out.